Hi, everyone, and welcome to the first RAMS Fast-15. I'm Dr. Andrew Starnes, president of SAM RAMS, and I'll be your host. The Fast-15 is designed to give you critical content that you need in 15 minutes flat. Today's goal is to provide information to help you navigate your personal finances in the era of COVID-19. Today's topic is finance in the era of COVID-19, and it's hosted by SAM RAMS and the SAM Industry Advisory Council. Members of the SAM Industry Advisory Council are Atlantic Pension Planning, Apollo MD, Leading Edge Medical Associates, Integrative Emergency Services, EM Recruits, Integrated Wealth Care, and Envision Physician Service. I encourage you to visit the IAC member websites for additional information on COVID-19. Specifically today, we're joined by Dr. Yogan Patel, President of Apollo MD, Jay Weinberg from Atlantic Pension Planning, Shane Ruffing, Founder and Managing Director of Integrated Wealth Care, and Dr. Faber White from Leading Edge Medical Associates. Thank you all for joining us today, and the clock is ticking, so let's jump right in. So the first thing we're going to talk about specifically is financial planning for COVID-19. We're going to cover a little bit about life insurance, disability insurance, and paycheck protection program. What you really need to do is make sure that you have appropriate levels of life and disability insurance, investigate the availability of a federally funded paycheck protection program at your location. And I would like to invite our panelists to add a very brief comment on this topic. Yeah.
I'll jump into that real quick, Andrew. Just a couple things that in all three of these, in life insurance and disability insurance, there are certainly changes that have been put into place by various insurance companies trying to accommodate traditional sales techniques in an era when a traditional model is not quite meaningful in terms of face-to-face representation, and particularly getting medical exams done to qualify for various insurances. The insurance companies are trying to implement very quickly both technology solutions as well as alternative ways to evaluate candidates for insurance. The other thing I've seen on the Paycheck Protection Program, this won't really apply, of course, to the medical student or resident audience, but for physicians that may be looking at this that are independent contractors, that's a great potential opportunity. There's a lot in that in terms of being able to obtain those funds and use those funds and the restrictions around it, but it's certainly an opportunity that definitely independent contractors or even smaller groups, democratic groups would have to take advantage of.
I think obviously as young professionals, many people know about life and disability insurance, but it is worthwhile just to drive that point home of looking deeper into these, especially in this important time where life and disability seem more common on our horizon, and then also to take that other step to look specifically at paycheck protection programs, which many of us don't necessarily know a lot about. We'll go to the next slide specifically and talk a little bit more about effectively managing our debt. Specifically, it's really important as we accumulate debt through the process of education, we focus on paying down that debt. You really want to target your most expensive debt first, which I think a lot of people recognize, but there are some subtleties on how to do that effectively. The most expensive debt tends to have the highest interest rate, and it's not tax deductible. And then the guiding principle should be that you want to pay down any non-tax deductible debt with rates above 5% before allocating income towards investments and leisure. Specifically, in regards to paying down debt and managing this, comments from our panelists on this topic.
This is Yogan, Apollo. I would just jump in very quickly. I help facilitate a lot of the recruitment for many of our practices, and the burden of med school debt in particular is absolutely just a travesty, and I think even with consolidation services, you're talking about rates 6, 7, 8%. So I think the ability to kind of restructure that debt as you're coming out is really important. I would make sure you investigate your options, talk to the groups that you may be looking at joining to see if they have a facilitated option. and take advantage of those. And I think the points you raised are great, that, you know, you want to focus on debt with the highest interest rate and the debts that are specifically not tax advantaged first, and then work down the priority list. This is also an area where if you're not someone that's financially savvy, talking to a professional or a financial planner may be important to have a plan going forward.
Thank you, Dr. Patel.
This is Jay Weinberg. I'm happy to chime in. Oh, on the debt as well. Many of my clients, namely resident physicians, a lot of their government student loan debt is somewhere in that 6 to 7% range. And as we all know, or should know, government has waived the interest on the government student loan debt through the end of September. Now, with that said, it's great that they've done that, but due to COVID, the interest rates on many of these private student loan refinances have come down significantly over the past few months because the entire global interest rate environment has dipped as well. So when we come out of this program from the government with the 0% interest on the loans, it may be a terrific opportunity for some of these physicians to explore a private refinance on some of their higher interest rate student loans, because when the rates go back to where they were, you know, would you rather have loans that are at 6 or 7%, or potentially refinance them and have an interest rate somewhere in that 3 or 4% range? So it's great for the short term, but when we come out of that, I think there's going to be some tremendous opportunities for many of these resident physicians and newer attendings.
Yeah, I would echo that. This is Shane with Integrated Wealth Care. I'll put a plug in for a group that's not on this call, but I believe they offer a great service. Doctors Without Quarters, if you're not familiar with them, is a group that provides consultation on student loan debt and can help understand the marketplace, understand refinancing, restructuring options. I believe they can also help shop the marketplace and get you actual offers, either by doing it for you or facilitating it on your behalf. And I would encourage people that do have a significant amount of student loan debt to really look into the opportunities that exist, as Jay just mentioned, and that exist just in terms of restructuring that debt to be as efficient and effective as possible.
All right, well, let's transition now and talk a little bit, instead of about the money that has been spent, about the money that's going to be spent. Specifically, let's talk about lifestyle inflation. This is something that we really caution against. Lifestyle inflation is what is described when you increase your spending as you increase your income. Once you've graduated from a residency program, your income is obviously likely to increase dramatically. Lifestyle inflation right after residency can really prevent you from paying down your student loans faster. And the longer you drag out your student loan payments, the more interest you'll pay over time. This is something that obviously has impacts not only on your loan repayment, but on your ability to save for retirement, and ultimately your ability to experience the lifestyle that you want long-term. We'll open this up as well to our panelists and see if anybody else has something to add here.
Yeah, this is Faber. I can jump in on this one as well. And I know everybody in this panel understands very clearly the axiom that I've kind of tried to go by and advise younger physicians coming out is: the longer you can live like a resident, the much better off you will be. That is a very difficult thing to do as your income increases coming out of residency. And it's awfully hard to kind of hold back against that spending, but it's so important to do that successfully. And not only that, but you'll also find as you come out of residency that it's awfully easy to borrow money. And so it actually hits you on the other side as well. Banks are more than willing to loan money to new physicians because they consider you a very, very good risk. And it's awfully easy, and I've seen it happen too many times, where physicians overborrow and get into a little bit of trouble, such that even their elevated income may not be enough to cover their responsibilities. One of the wisest things I heard from a physician who told me, you know, the three most important measures of or factors that determine your success as a physician later on one of them is to borrow only half as much as the bank's willing to give you as a way to stay out of trouble. The other two things he said, which I also think are very good. One is stay married to your first wife and don't buy a house that only another physician can buy. So for what that's
smart man.
Very, very wise man who made some mistakes of his own and didn't want anybody else to make the same ones.
I can speak to this. I know it's difficult to really stay disciplined through this process as you spend so much time working. It just feels like you want the payoff to come quickly, but you have to be disciplined to get through this process of education and training, and staying disciplined through the process of navigating that higher income is also, I think, just critically important.
Yeah, I'll weigh in on that. This is Shane. I completely agree with Dr. White's comments, and Dr. Patel earlier referenced the need to have a plan of some sort. Spending can involve a lot of things as you transition into practice and have a significantly higher amount of discretionary cash flow. Where it does get into trouble, as Dr. White referenced, over borrowing, a lot of consumption, I'll call it, on lifestyle type things. A big advantage, though, of having 10 times the income, hypothetically, is to the ability to structure the things that are important to you first, and fully fund them before you start making discretionary spending decisions. And what you'll find in most cases, having done this many, many times, is that you are able, if you prioritize the financial spend or consumption around what's most important to you, your wife, your family, things like fully funding various retirement programs with intentionality, paying down your student loan debt on a reasonable and aggressive schedule, borrowing and appropriately structuring a home that's right for you and your family. It's a great comment. That is not necessarily a home that only another physician can afford. You'll find that what's left over after that planning is typically enough to accommodate a very healthy and comfortable lifestyle. It's really just a matter of taking the time up front to prioritize and articulate and document what you want to accomplish and over what time frame. And then what's left of that, you should have more or less free reign to do what you want to.
I think we've touched on this idea then of financial health and planning specifically about how you want your health to grow long term, your wealth to grow long term. That'll take us to our next slide, which is on financial planning. What we would advise is to set up a sound and diversified financial plan. That's really a key to enhancing your lifetime standard of living. Components of a sound financial planning would specifically include maximizing your Roth IRA contributions, maximizing employer-sponsored retirement plan contributions, and investment in inexpensive, well-diversified index funds. Now, I would say specifically to residents and students and early graduates that aren't aware of what these are, all of these things are things that you can easily learn the basics of, and are really fundamental to having a financial sound plan for your future. There's a lot that these touch on, but again, I'd open it up to our panelists for any comments specifically that you have on these areas.
Yeah, this is Shane again. I'm sorry, I'll just go real quick. I'll just weigh in on the Roth piece of it. This is a fantastic opportunity for typically MS4s through final PGY folks to maximize a Roth IRA. And without getting into all the complexities or details of that, you, as in that population, that time frame, that limited finite time frame in your career, you are in the lowest income tax environment you are ever going to be in. And so take advantage of programs like a Roth IRA that allow you to essentially lock in the lifetime tax bracket that you're in right now, which is, again, as low as it's ever going to be, and then access that money in the future tax-free when you will be in a meaningfully higher income tax environment. It's a great opportunity, and I would recommend doing that to the extent of prioritizing it over many, many other things.
Absolutely.
I would agree 100%, Shane. I think that's probably one of the wisest pieces of advice that I had gotten coming out of residency. The other thing is, over the last 5 years, I think there really has been an explosion of resources, everything from, financial independence and retirement early, this kind of physician on fire movement, the blogs related to that. So there's a ton of content out there. And even if you're not somebody that is thinking about retiring early, you can certainly take a few pages out of those books, right? And use that to kind of structure your first few years out of residency. So we advise any residents that are joining us to really, lay out a detailed financial plan like you've advised here. Lay out the critical expenses, your priorities. You're going to be taking board exams. You're going to probably have some reunions with friends from residency colleagues, et cetera. So lay all of those priorities out so you know exactly what you're going to need to spend and what you can save. And I think doing that also forces some discipline in those early years that then you can build on later.
They're all great points. I think that oftentimes people are intimidated by this because of the vastness of all the different things that you can look at. But like it was mentioned, there really are a multiplicity of really easily understandable, easily available resources, specifically online, that can introduce you to these things to get you started on the right track. Of course, then the question comes up, and that's really what our next slide is going to be about, is what about when you get to the level where you think that you might benefit from working with a professional? Oftentimes, it does pay to a point to have professional guidance. You can utilize the services of a financial advisor that can help you create strategies for eliminating financial risk and building wealth over the long term. There are specific questions that we would suggest you ask, like, is he or she a certified financial planner? What is their pay structure? And is there a code of ethics that the planner follows? I know there's a lot of different thoughts about this. What specifically would our panelists advise in this area?
This is Jay Weinberg. I'll chime in on this one for a minute. When people ask, what to look for in a financial planner, letters next to their name are certainly important, but that is not the only thing you should consider, because you can have certain designations and have 1 or 2 years experience, and that doesn't make it that doesn't make you a better financial planner if you have 1 or 2 years experience if you have letters next to your name. I think you want to focus more so on the type of clients that you're taking on and your experience in the business, and the fact that you are independent and can represent many different insurance companies or many different investment companies. And I think that holds more weight than letters next to your name. So just take that into consideration, because I think that should be something to consider.
Yeah, and I'll echo that just with the final 2 bullet points on here. One, hopefully everybody has a code of ethics. I would like to think that. And most planners and planning offices, advisory offices, will have a written code of ethics. So if that's something that's important to you, you should be able to request that. And that's documentation to be provided. It typically is called a fiduciary agreement in the financial planning world. It's similar, a lot of similar conceptual terms, but a planner that you consider working with will likely have that. The biggest one, I think the most important one, is the second to the last bullet. What's the planner's pay structure? There are a number of different ways that financial professionals are compensated, and there's not really one that's better or worse than the other. The thing that I believe is most important as you're potentially interviewing people to work with is to understand it. Ask that person, how are they compensated? What are their motivations, et cetera. And regardless of what the answer is, if you understand it and are comfortable and agree with it, then it's fine. If there's a vague answer, or you can't understand the answer for some reason, then there's probably some more due diligence that should be done there. But the main thing is just to understand what is the compensation of the advisor you're working with, how is it structured, and are you comfortable with it? And whatever it may be, if it's an arm's length transaction and you both agree to it, then it should be totally fine.
Yeah, I may be a little bit of an anomaly here in that I'm out about 12 years now, and I have never used a financial planner. Now, that's not to say that that I wouldn't have benefited from using one along the way. I also just have a huge personal passion and interest in personal finance. And so I think I would make sure that people understand it's certainly doable, but it will take time. This is an education. There are a number of things you have to make yourself abreast of. And the reality is, as a practicing clinician, you will never have as much time as needed to be able to properly analyze markets, understand risk. It can be overwhelming. So I think there's certainly pros to using a financial planner. And I would agree with Shane's point that just understand their incentives, understand the relationship, and where you may need to provide some extra input. But whether you use someone or not, I feel very strongly that every resident coming out, every new attending should have financial literacy as a part of their general practice. I mean, this is one of those things that you have to invest in. So again, there are tons of free resources out there. I would start with those. I would really understand capital markets. I would understand index funds and what you're buying, understand ETFs, understand insurance products. These are things that, if you've gone through biochemistry and multiple years of residency or fellowship, you can master this and at least educate yourself so that you're a better consumer of financial planning resources when the timing may be right for you.
Well said.
I think we've covered a lot of great material. Let's go now to a quick Q&A. So let's start with specifically a question for Shane. What can you do with student loan payments that have been suspended? I know you touched on this earlier, but just to recap.
Yeah, so it depends a little bit on the audience, obviously. If you're in a situation where you've refinanced your debt and it's with a private lender and you're paying $100 a month, for example, which is common, this isn't an opportunity. Your debt or your payments have not been suspended, it's not been suspended, et cetera. For folks that are maybe that have not done that, or that are pursuing other interest repayment options or debt repayment options, are planning for or were planning for public loan forgiveness in the future, or they're in the first couple of years out in practice and are making meaningful payments back towards their loans, this really does represent an opportunity, I think, to have a potentially significant amount of unexpected available cash flow. Some of the things that we have found, I think, to effectively utilize that are using it to fund, certainly to pay off higher interest debt. That's if you're in a situation where there's a lot of unsecured debt, credit card debt, et cetera. This is a great opportunity to redirect those payments to that debt. If that's not a priority for you, this is a great opportunity to use that money to fund things like a Roth IRA we mentioned earlier, to fund individual savings objectives, to put bolus payments into savings objectives that you may have had for your children's education or your own retirement. If you're in a situation where you haven't filed your taxes yet for 2019, then you can still fund a Roth IRA or a backdoor Roth IRA for last year. With this money, you can use it to fund what's called a SEP IRA for last year and reduce the 2019 taxes. There are a lot of things that potentially could be used in a time when, depending on your monthly payment, you pick up an extra 6 months worth of unexpected available cash flow.
Okay. So then we'll go on to a next very common question. We'll ask this one to Jay. When should I secure a life insurance policy?
Life insurance, I want to say there's wanting life insurance and there's needing life insurance. The time that you need a life insurance policy is when you're married, when you have dependents, and when you have co-signers on loans. So you could be 26, 28, 30 years old and need life insurance, and that's going to be the time to get it. These policies, they don't cost a lot of money. Maybe if you're 26 or 28 years old and very healthy, you can get yourself $1 million of 20-year term life insurance for maybe $300 a year, maybe a little bit more, a little bit less. So you can certainly afford it when you're in your training years. And then there's wanting life insurance. Even if you don't fit the bill for married dependents or co-signers, you still may want to secure a policy for later. And there's absolutely nothing wrong with that. But it's totally up to you.
Okay. Another common question would be, we'll direct this one to Dr. Patel. What are some of the pros and cons of incorporating?
Yeah, that's a great question. So my first job out of residency, I was employee, and after that job, about a year later, I wound up joining a group that was, I joined Apollo, and I was an IC, and I've been an IC now for 11 years, and I incorporated right off the bat. For independent contractors, I think organization is critical. And incorporation for me was an important step in that regard. It allowed me to segregate business-related expenses, to track them, to report them, and to better delineate personal versus professional finance. Some of the other kind of practical tips, one, when I incorporated, it allowed me to then employ my spouse to help with scheduling and supporting our LLC. Ultimately, it allowed me to establish a 401k that contributed for both of our retirements. And then ultimately that evolved into setting up and supporting a defined benefit plan. I think the cons are not insignificant, but again, easily manageable. There's a little bit of expense in starting up and establishing the LLC. You use a third-party payroll processor, and so there's some fees annually associated with that. And then tax filings, right? You file an 1120 for your corporation every year, so you'll pay a little bit of extra to your accountant. But in my experience, the ability to kind of keep those things distinct and separate, and then the associated deductions for the business have just been huge. And I think overall organization is just much simpler when you're incorporated. As a added benefit through the Paycheck Protection Program that rolled out, the Payroll Protection Program, I know for a fact that many of our ICs that were incorporated had a much easier time in the beginning of getting through that process. They were able to call their payroll processing company, get a 940, 941 statement, and upload that immediately to their local bank. I think those that had not incorporated had a few additional hurdles to get through. So, but would open up to the rest of the panel if anyone else has thoughts there.
Well, I would ask is just a quick follow-up question on that, Dr. Patel. Obviously, you employ a lot of providers as independent contractors. What would sort of just your one-line response be when someone says, what's the best resource that I can go to educate myself on how to successfully incorporate?
Yeah, gosh, there are a number of physician blogs that are out there that talk through this process. When I came out, James Deal was just getting started with White Coat Investor, and I think he had some great resources out there. I think there are a host of others these days. Again, the nuts and bolts are not that challenging. If you have assets or your spouse has assets and you want to investigate asset protection along with that, then consulting an attorney on this is not unreasonable. You may, in fact, already be using an attorney to review your first contract, and the same person may be able to guide you through the basics of establishing an LLC. So, but I think it's worth taking that time, making those investments on the front end, because once you set it up, I mean, I've had the same structure now for 11 years, and I can tell you, by luck or by happenstance, the way I set it up actually wound up being hugely beneficial for me later in my career, specifically regarding the way our defined benefit plan was then later organized.
Okay, great.
Yeah, I'll weigh in on that. I completely agree with everything Dr. Patel just said. One of those are many of the advantages of incorporation. What I find intriguing is that most younger physicians or physicians newer in their career, early in their career, the reason they initially think they're exploring incorporation is for tax purposes. And although there are related tax benefits, such as defined benefit plans and other things, I think the immediate gut check reaction is, I'm going to protect my assets and I'm going to have tax reduction by having an incorporated entity. And those are potentially side benefits. It's just a bigger, more broad conversation. So there is more to it than simply trying to create a veil of tax shelter.
Great. We'll do the next question for Dr. White. How can I take advantage of current insurance qualification guidelines?
Absolutely. Especially one of the things we haven't spent a whole lot of time talking about, although I think we touched on it a little bit earlier, was the importance of disability insurance. You spent a lot of time as a medical student, as a resident, building up the ability to generate a pretty high income for yourself. And you definitely want to protect that in the event that you are injured. And unable to perform your duties, one of the things that's important with regard to disability insurance is making sure that it's locked into your particular occupation. That's a very important clause. And a second aspect to it is that you should ensure that, unlike a lot of benefits, you want paid for with pre-tax dollars if you can engineer it that way. Disability insurance, you may want to consider paying for that with after-tax dollars, because if you do that, then any benefits that are paid out are also tax-free, as opposed to taxable if they're paid for with pre-tax dollars in terms of the premiums. Disability insurance is often tied to the amount of income that you can generate. And so you'll find as you advance in your career and your income goes up, you'll be able to get more disability insurance. It usually caps out. I believe mine's capped out at around $10,000 a month. And so that's kind of a good goal that you want to shoot for, although you can likely get higher amounts. And the final thing I would say about that is you may want to consider getting your own disability insurance so that it's portable rather than through your employer. You can certainly do both. I have both through my employer as well as my own personal policy that I got right after I finished my residency 15 years ago that I've just continued to maintain. So definitely talk to somebody and make sure that your assets are protected with regard to instances where you may get hurt. We've discussed life insurance policies as well. Term life insurance, I think, absolutely is the way to go, as has already been discussed. Very inexpensive. Regulations are such now that really with both disability and life insurance, you're able to secure that with minimal questions and no physical exam in many cases. So certainly you want to take advantage of that as well.
Thank you. Next question will go to Shane. What can I do to take maximum advantage of my July 15th tax deadline?
Sure. So I highlighted this a little bit earlier, but if you have not yet filed, and if you have, it doesn't mean you can't do this, it just requires an amendment. But if you have not yet filed, as everyone likely knows, the tax filing deadline was pushed off to July 15th, April 15th. And that gives you some extra time to fund things like a Roth IRA for 2019. If you have extra cash right now, or extra cash flow because of student loan payments that have been suspended, or potentially bonus income or other things that may be coming in, that money can be used to fund a 2019 Roth IRA as well as 2020 Roth IRA. You can also use it to fund, as I mentioned earlier, a SEP IRA before July 15th. And the beautiful thing about that is that the fact that it's now the early part of June in 2020 does not preclude you from being able to fund and reduce your taxation on a SEP IRA 2019. That only works if you have 1099 or moonlighting income that would not run through if you're a resident through your house staff program or through employer group. But if you do have outside consulting income for last year, moonlighting income, et cetera, that you're going to be paying self-employment taxes on, I would definitely consider using a SEP IRA or looking at funding a SEP IRA and reduce that tax bill. And if you already filed your taxes for last year, but you feel like you wanted to or would have liked to take advantage of some of these things, you can simply file an amendment. If you have a CPA, that's very easy for them to do. If you do your own taxes, most of the major tax programs will give you an option for walking through how to file an amendment. And then you can simply note what you want to do for last year.
Okay. We've got so much great material here and had so many responses. I think we'll just do one final question. And I would ask this one to Dr. White and Dr. Patel. I think that you guys are on the front lines of this and see this a lot. What changes do you see occurring in the current market as a result of COVID-19, and how can those best be navigated? We'll say Dr. Patel, if you want to answer that first, and then Dr. White.
Sure, absolutely. I mean, I think first off, everyone should remember that we're always going to be needed at the bedside. So there's a tremendous amount of uncertainty right now. It's important to focus your efforts on understanding the practice you're looking at as a potential employer, and what is the stability and security of that practice. Globally, 40 to 50% reductions in EM volume have been reported. Some of that is starting to come back, but most practices have had to make sacrifices. They've reduced shifts. They've cut hours. Many have reported salary cuts. I've heard of many incoming hires having their offers rescinded. So, in this kind of environment, I think it's important to understand the history and context of the practice you may be joining. Universally, the job markets are going to be tight, probably for the foreseeable 18 months. So understand what the group's plan is for staffing as volumes come back. Are they going to be adding APP staffing versus physician staffing? Are the current partners happy with the hours they're getting? I think more fundamentally, what is the nature of the group? Are they subsidized or are they able to survive just based on the community and the payer mix? And what does that mean for your ability or your practice's ability to weather a financial storm? I think, the acuity is likely going to be high this fall. So you're going to want to be in a practice that is well supported, that has good coverage, that is adding physician hours appropriately as patients start returning to the ED. And then ultimately, what is the compensation model and how are you as an individual at risk? So for example, many of our practices have had extremely low volumes at night. So the overnight shifts, some of the weekend shifts have had very little patient flow. And that means, your RVU production on those shifts is really low. So is there some protection within the group for that? In addition, if you're somebody that is newly graduating, think about your flexibility as an individual. So what is a critical need that the group may have? It may be nights, it may be weekends, it may actually be surge shifts where they may want to have call shifts when the ED is overwhelmed. And if you're somebody that is in a position to be flexible, think about that, because that may be financially rewarding for you, but it may also make the difference between you and 6 other candidates for that same position. The last thing I'll say is you are never going to be more flexible than you are today. And I was told that by my chief, and during my chief year, I told that to my colleagues coming out of training, and it holds true today. That over time, especially for those that get married, that have relationships, you buy a house, you have a mortgage, you may have a boat. I mean, all of these things are things that decrease your flexibility in life. So as you're coming into the job market, use that flexibility to your advantage. And ultimately that's going to allow you to optimize your financial situation early in your career.
Yeah, this is Faber. I would absolutely agree with everything Dr. Patel just mentioned, particularly about being flexible. The demand in the job market for physicians is always going to wax and wane. It's waxed and waned many times over the course of my career. We are in an environment right now where groups are, and my group has, and I know a lot of other groups have as well, kind of cut back on hours, which ultimately translates into cutting back on shifts, which does decrease the opportunities available at this time. But there are still a lot of opportunities out there, and I would encourage everyone who's coming out in this environment to not be discouraged, because this is temporary, and we do feel like the demand is going to return. It always does. There are other options available out there as well. When I finished my training, I spent an extra year doing a fellowship, which ended up giving me an additional tool in my toolbox to market myself to other groups, and that turned out to be a highly positive thing. So I would consider looking at fellowship opportunities if anyone has an interest in that, as a way to beef up your credentials a little bit. And then the other thing is, with every challenge comes tremendous opportunities as well. One of the things we're seeing a lot right now and trying to figure out how to incorporate in our practice is telemedicine. And if that's something that anyone has a particular affinity for or interest in, that's like it or not, that's going to be a reality going forward as we figure out all of the idiosyncrasies regarding virtual visits. And that's just one of many different avenues that you can take to try to beef up your skill set and make yourself more attractive to any group that you may be looking at going to.
Great. Well, thank you so much for that. Though the demand may wax and wane, clearly the demand will always be there and constant for the kind of knowledge for the financial health that we've discussed today. Finally, the members of the Industry Advisory Council have provided links to these additional resources. This presentation will be available to you on the Industry Advisory Council's webpage on saem.org. Feel free to access it at any time. And thank you again to everyone for joining us, specifically to our panelists, Mr. Ruffing, Dr. White, Mr. Weinberg and Dr. Patel for sharing your expertise and your insights and for helping SAM members navigate this COVID crisis just a little bit better. Stay safe and be well.
Thank you, Andrew.
Thank you, gentlemen.
Thank you.
Ladies.